So I'm going to shift over to flow-through shares and just cover off more just the sort of the main areas that are of note when you're issuing flow-through shares, things to keep in mind. So in our outline, we're going to go through what really a flow-through share is, what expenditures can be funded or can be incurred to use up those flow-through proceeds that are eligible, how the look-back rule works, what is a super flow-through share, what happens if you have a shortfall on your spending flow-through, and sort of the focus on some of the recent CRA audits that we've seen and what sort of areas that they look at that they challenge potentially the expenditures that are reported or claimed. So what is a flow-through share? So essentially, for those of you who haven't had a lot of experience with them, it's pretty much the same as any ordinary common share, but you have the benefit of having expenditures or exploration costs that the company incurs passed on to you as an investor, and which makes it quite an attractive investment from the investor's point of view, which also obviously makes it attractive for raising capital for the company in order to conduct the exploration work. So as long as the corporation is also meeting its conditions, it can issue these shares through a flow-through share agreement. So the agreement basically determines the timing and the terms of of when the money must be spent and when the renunciations would take place. And of course, the expenditures are passed on upon that renunciation. So what companies qualify to issue these types of shares? The Income Tax Act defines what a principal business corporation is. And so to meet the conditions of issuing flow-through, you must be a principal business corporation. Essentially, it'd mean one of three things. Your business is mining or exploration, or processing or marketing of the metals or minerals, or it's a holding company which has assets that are 90% or more represented by the shares of another company that meet one of the other two conditions. So in order to, of course, do this, there must be a subscription agreement that details the terms and the conditions. Unless it's modified in some way. Generally, the company has 2 years to incur these costs and meet the conditions of the renunciation. And only the costs that are incurred after the date of the subscription agreement would qualify towards meeting the commitments made under the flow-through. So in other words, no warehousing. So incurring costs before your subscription date won't count towards meeting your flow-through spending requirements. So in a nutshell, the company forgoes the tax deduction. Investor gets the tax deduction for them personally, or if it's a corporation that's invested, they get to deduct it against their own taxes. On the downside, of course, the shares that the investor holds now have a tax cost base of nil. So upon selling the shares, you would essentially have a capital gain equivalent to what your proceeds are on the sale. Fortunately for individual investors, so non-corporate ones, you have the benefit of an additional investment tax credit that we'll mention a bit more of shortly. So what types of expenses qualify for this program? Essentially, it's the portions of the definition of what a Canadian exploration expenditure is. And some of the examples of that include prospecting, drilling, geological, test pits, sampling to a limited amount. That's been challenged a bit by CRA as to what's considered eligible sampling. Some of the other not so obvious ones would be the costs incurred to bring the mine into production, so they would include things like clearing and removing overburden, stripping, sinking a mine shaft, or constructing an underground entry. So what doesn't qualify? So basically the direct costs of exploration are covered by it. You can definitely claim those, but things that are overhead, or what they call pseudo expenses, which would include things like administration or management, financing costs, the salaries or wages of staff that aren't 90% or more spending their time on direct exploration type work, the maintenance or rental property where you're not using it 90% of the time directly in the exploration, the acquisition costs of the mineral property itself, or keeping the title in good standing, and of course acquisition costs of where you're purchasing things like equipment. So if you're leasing equipment, those would be eligible costs. If you're purchasing it, there's no deducting of the capital costs of those types of items. So just on an administrative side for reference, future reference, just some of the forms that are needed that you would need to file. Really where you start off, you get your ID number by filing to T100A. The other two, T100B and C, are really only required in certain circumstances. So if you had, if you were filing the initial for your ID number as an estimate because you didn't really know how much money you were going to raise at the time, but you had an idea, you would file that form T100B to make that adjustment to confirm what the actual is. And then the last one, if you had warrants that were tied to those shares, then you would have to also file that form to report that as well. And essentially the deadline to get the T100A in would be within a month of your instrument or your selling instrument or the date of your agreement. So just something to keep in mind if you are intending to raise capital through it, that you'll want to address the T100A form earlier on so that you're not missing any deadlines. Just some other points to keep in mind to keep the company on side as well as the investors is there should not be any other economic benefits to the shares that are issued. They should be in all other ways. They should just be straightforward common shares, aside from the fact that they have the renunciation aspect to them, that benefit. There can't be any guarantee against loss, or the only real guarantee against loss, really, there can be an indemnity clause. So if the company doesn't end up spending the money as they're supposed to, or fulfilling their commitment under the flow-through, then the company can reimburse them for the costs that they incurred for losing those tax deductions as a result of going offside with spending the money. So the look-back rule, how does that work? So this is a really common use of flow-through because essentially it allows you to renounce to the investors right at the end of the year, not spend any money at that point. The investors get their deduction in year one, but you don't actually spend the money until year two. So ultimately, there's a 2-year window that you can spend the money in. Effectively, the company commits to spending the money by the end of year two. It then renounces by March 31st of year two, so that the investors can report it for tax deductions in year one. The only downfall is that there's something called Part 12.6 tax, and so as you can imagine, CRA is not going to, without a cost, allow you to hand out deductions to investors and not incur those costs until a year later. So what they've said is you can do that, but you'll pay what we call a Part 12.6 tax, which is effectively like paying interest on that money that was renounced. So the Part 12.6 is calculated monthly on whatever the remaining unspent balance is in year two. So each month you would work out how much was unspent, and based on the prescribed interest rate that CRA puts out, you would have to calculate what that amount is. And you would essentially file that on T101C form. So one of the other somewhat common situations we do come across at times is where we have a company that's got a subsidiary that owns the property, but the public company is actually the parent of that company holding the property. So what happens is the parent wants to issue flow-through shares and renounce, but the exploration company, the subsidiary, is the one that's incurring the cost. So essentially what happens is you have two issuances of flow-through shares. The public company issues to the investors, and the subsidiary issues flow-through shares to the parent. Now the only issue there is that there's a catch when it comes to the look-back rule. So the parent can do the look-back and renounce and spend the money in the subsequent year. The exploration company can't use that as a deferral. So ultimately what happens is, normally we suggest that the exploration company renounces and files their forms to allow for on a monthly basis instead of waiting till the end of the year, so that the parent company receives those expenditures along the way and isn't deferring that till the end of the year, paying the Part 12.6 tax. So the exploration company renounces as it spends, and the parent company basically recognizes that in year 2 as their fulfillment of the commitment. What we commonly see is the plan is to do this type of arrangement, but the second element of issuing the flow-through shares from the subsidiary to the parent gets missed. So just keep in mind, if you do have this type of an arrangement, make sure that you go through the process of issuing shares between the companies so that you're on side. And as I said before, you'll probably want to get into a habit of issue or renouncing that money up to the parent monthly so that the parent isn't incurring Part 12.6 unnecessarily. So moving on to what we call super flow through. Essentially it's just a word they like to throw around to describe the 15% non-refundable federal income tax or investment tax credit that the government's given to investors that are individuals. There's certain provinces that actually have a provincial tax credit as well. As you can see, BC's got a 20% provincial credit. So as you add it up, it can be quite a lot of benefit to an individual investor. Unfortunately, the corporations that invest in flow-through shares would not have this 15% additional tax credit. For ones in Quebec, they actually have an even more attractive program on it, and it'll actually allows a deduction up to 150% of the cost to the investors. And it came in 2000, in the year 2000. Each year they essentially extend it for one more year, and they've extended it again. So for the foreseeable future, they're now starting to draw back on these types of incentive programs. So it is in place for another year, but then it might be questionable whether they'll extend it again. So what happens if there's a shortfall? So this is the unfortunate situation where we often get involved to basically help sort out where you have to go from there. So unfortunately, you don't end up spending the money in the time that you expected. So what happens is there's a Part 12.6 tax that, in addition to the monthly amount that you have to calculate on the unspent balance, whatever you haven't spent by the end of year 2 will also get hit with another 10%. In addition to that, you would need to file what we call a T101B form, which basically amends the slips that have gone out to the investors, reducing how much they receive as a deduction, which obviously is not something that most investors want to see after the fact. Ultimately, they might see interest and penalties associated with that. Now, one option that you have is that there's a 24-month window. So let's say that your subscription agreement is dated April 1 of year 1, you actually have until March 31 of year 3 to spend that money. The only catch is that whatever you would spend between January and March of that year 3 would end up getting shifted from the year 1 renunciation to year 3. So what that means is investors would have to, their deduction would be denied in year 1, but they would get it in year 3. So it's really just a deferral of the deduction. The company would have to spend the remaining money in that time, however. So that's the one thing to keep in mind about the 24 months. So where is CRA focusing on the audits of these? Essentially, they do tend to go after things that are reports. There's certain types of reports that do qualify, others that don't. They also tend to focus on anything that looks like a capital item. So if you're buying equipment, or if you're constructing temporary structures at the camp, they tend to be gray areas. So we've had some success with arguing in certain situations and not in others. So it really comes down to the specifics of what has been constructed. Of course, overhead expenditures we mentioned earlier, they would be denied. And sort of study costs. So the costs that are denied really in regards to studies are whether continuing on with the program would be profitable to the company, as opposed to studies that analyze what your results are from your drilling. So the actual profitability aspect of it, they don't allow you to claim those costs. There are some areas with consultation costs, sometimes community development type costs. Depending on the circumstances, those often will be denied, but there are limited circumstances where you can argue for them. Environmental studies is another one. So essentially, if the environmental work is done to meet a legal or informal obligation under the terms of a permit, those costs would be allowed. Things like sampling and monitoring. However, if, and it really comes down to the specifics of it, if the environmental assessments are requirement to obtain a permit, they deny it. So if you're doing the environmental studies before you get the permit, they tend to deny those costs. And unfortunately, that means the general baseline type environmental studies as well. So feasibility studies, again, it's sort of the same. They look at it as if it's directly connected to the exploration and determining whether your samples are what the quality is of them. They'll allow you to accept those, but where you're undertaking whether it's a decision to continue to explore, those they tend to deny.